Welcome back, folks. This is the ICT Mentorship Daily Log Entry for March 15th, 2021. Dollar index, euro, pound dollar, and the gold homework. All right, here we have the dollar index as our 15-minute time frame. I'm just going to get right into it. Relative equal highs. We tapped into that today at London close. Buy side liquidity pool swept essentially for about 10 pips. Breaker back here, bullish breaker. Order block after running sell side liquidity. Optimal trade entry, London open kill zone. Bullish order block, OTE, attacking the buy side liquidity pool relative equal highs. Optimal trade entry into New York open with bullish order block here. And there's another one here from this low to this high, back down in. Fair value gap, order block, New York open, attacking the buy side liquidity pool here. As a note in continuation of what I taught this weekend, I'm showing the time in daylight savings time. But the kill zones are set on the times I gave you over the weekend without daylight savings times actually applied to the chart. In other words, I put those kill zones on with -5. Now it's -4, which adjusts for daylight savings time in New York. So these are the kill zones that stay static all year long for me. They don't change. The time is going to change, but the kill zones will not change from the times I said and taught you over the weekend. All right, here's euro. This is going to be really short. Marc has done hardly anything today. Just one of those consolidation days, hasn't done much at all. Every short-term low is swept and every short-term high is swept. So essentially this is kind of like a mini seek and destroy type of day. It's not going to give you much at all. Not that you can't find 10 pips in here, is you have to be very, very nimble. The rejection block over here being swept there, and the small little sell side imbalance, buy side inefficiency up here at the start of the day that sells off. Apart from that, really been a lackluster day for euro. All right, British pound versus US dollars, a 15-minute time frame. Buy side liquidity pool rallies up, takes the buy side out, sell side imbalance, buy side inefficiency. Bearish order block, extended that in time. Midnight, New York, decline down in here and rallies back up into the bearish order block, London open kill zone. So we already had a high clear relative equal highs. So when it runs up like this, it's very difficult to trust it when you're new, but this high tends to stay intact. Or if it runs to it one more time, that'll end up becoming the final straw on the camel's back that breaks it and then trades lower. But British pound has no interest in going any higher here. Sells off, small little fair value gap in here. Trades back up into it again during New York open. Sells off, consolidates, distribution. Small fair value gap in here. Institutional order flow entry drill. Attacking sell side liquidity. Retesting the imbalance, not just the low. And aggressively runs for sell side liquidity over here. If you look at a hourly chart, so this is something for you to do yourself, on this swing here, look at it on an hourly chart and use my swing projection model for the fib, laying it on the bodies to the bodies. And you'll get this level down here. The 60-minute swing projection gets real close to the low. I'm going to take your attention up to the big figure here at 139 big figure. If we're trading down through it, how many pips can it trade through the big figure? 10, 20, 30, and as much as 40 pips. Okay? This decline trades down into 40 pips. Notice that? So we have 38.60 it trades to, below this low, and this low here. And then we had the market trade higher. Low of the day forming in London close kill zone. All right, I gave you homework last week, and it was, why did gold offer a buying opportunity here, and why did it trade to this level here? Now, if you haven't done this, if you haven't gone through your charts and looked at it, you are about to see why. So pause your video and study this chart here and come up with your own reasons as to why. Some of you aren't really keeping up with the live current commentaries. Why, I don't know, but it's important for you to do these exercises. If you don't, you're wasting your opportunity. So let's take a look at the annotations. First and foremost, on a 4-hour chart, we have a low, high, lower low, and then runs away. So we have a breaker here. This is a bullish breaker. It's the last up close candle prior to that lower low being formed and then trading higher above it. Take the high of the breaker and the low projected in time. You can already see it comes down and trades rather handsomely off of that. The 4-hour bearish order block, we're framing that as well. On the hourly chart, you can start to see a little bit more detail. All I did was kept levels here and keeping the frame of reference in view. Just this is the 4-hour order block, but now it's broken up over multiple candles. And then here is the 15-minute time frame. Dealing range low here. Why here? We have a nice dynamic move off of that. We retrace. You could use this low as well. So in your homework, if you have this low or this low, it's still the same. You're still going to get the discount market that's over here. The high on that dealing range is here. So from low to high, you're down inside of a discount relative to this high and that low, or optimal trade entry. We have a sell side liquidity pool here. And then right in here, we have the fair value gap. So the market trades down to, again, don't forget this low here, this line. That's the low end or discount level of the 4-hour bullish breaker. This is the high end or premium end of that 4-hour breaker. Market trades lower, consolidates, creates a buy side liquidity pool prior to dropping down. So this buy here offers a target here. So relative equal highs inside of that 4-hour bearish order block. Let's take a closer look inside of here and get an x-ray view of what price was actually doing. All right, now I taught you as relates to the dollar index, I like to refer to gold. Gold is like a little filter for me. It helps me ferret out some of the signals and doesn't always speak, but when it does, it usually confirms something that I already see in price anyway. And this is a SMT study, so smart money technique or smart money tool. And we're looking at when price was trading into that fair value gap over here and below these relative equal lows inside of optimal trade entry with relative equal highs still in play. Inside of this area here, look what was happening. Gold was failing to make lower lows here. It was making higher lows. At the same time, the dollar was going higher as well. That should not happen. If you're looking at gold and it's making higher highs, dollar should be making lower lows. If gold is making lower lows, dollar should be making higher highs. And I just reversed the way the charts were showing. So now we have the dollar index with the gold market shown as a line chart. And you can clearly see that while this was going higher, gold was making higher lows. So graphically, what does it look like? This is what I'm trying to illustrate to you. If gold makes a lower low like that, that should be seen with a higher high in dollar. Now, if we reverse this, and this is dollar and this is gold, the same would be true. This market going higher, if it was gold, should be seen with a lower low in dollar and vice versa. This is a symmetrical market. If there ever is a time when this does not reflect like it is here, it is an x-ray view inside of price action where you can see the algorithm cracking, if you will. It's like a small little signature, so that way when you see that, something is going on behind the scenes, and it's usually accumulation. And you can see they've accumulated gold here in the form of longs, targeting this area up here for liquidity. And that's exactly where price went to. There. So that was your homework. If you didn't get all that, that's okay. At least you learned something here. The new homework I have for you, it's basically the entire week. I want you to look for 10 pip setups. If you can do it live with a paper trade, watching it live, that's great. If you can do it with a demo account, that's even better. Now, I know I stated that you should not be using a demo account until I prompt you, and this is one of those instances where I'm prompting you. You want to create a brand new demo account, and you want to try to use 1% of the account, and you're going to be risking 10 pips to make 10 pips. You're going to be focusing on the London session or New York session only. You can pick any pair you want, but you have to get out at 10 pips profit or stopped out at 10 pips stop loss. One or the other, that's what has to happen. But you're looking for opportunities where the market's going to run higher or lower relative to the things you're learning. Do not grade yourself on how often or if you're able to do it. Okay, I'm going to teach you a lot about this weekend, so you can go in and start practicing and doing exercises. But you have to test it first. Just get a baseline where you are. That way, once you learn what I teach you this weekend in the lesson, you'll have a whole lot more framework so you can go in and find more setups. Hopefully you found this insightful. Until I talk to you tomorrow, be safe.